Today we're looking at which company is most profitable based on their profit margins from 2022 to 2024. Let's start with Ayala Corporation. In 2022, their profit margin before tax was approximately 20.69% and after tax around 20.55%. In 2023, their profit margin before tax increased significantly to about 50.77% and after tax approximately 50.55%. By 2024, their profit margins are projected to be around 1.26.92%, both before and after tax. So Ayala Corporation shows a steady increase in profitability over these years. Now let's look at San Miguel Corporation. In 2022, their profit margin before tax was roughly negative 43.35% and after tax about negative 29.0%, which indicates a loss. In 2023, their profit before tax remains negative at around negative 41.49% and after tax approximately negative 48.97%. For 2024, the margins are still negative, around negative 29.76% for before tax and negative 26.47% for after tax. This indicates that San Miguel has been consistently unprofitable over these years. So, based on the profit margins, Ayala Corporation is the most profitable company, especially considering the consistent increase in positive margins from 2022 to 2024. San Miguel Corporation, on the other hand, has been facing losses. I will be discussing which company demonstrates the strongest financial efficiency based on their return on asset and return on equity for the year 2022, 2023, and 2024. Let's begin with Ayala Corporation. In 2022, Ayala's return on asset before was 3.47% and after was 3.45%. Its return on equity before was 6.51% and after was 6.47%. By 2023, the ROA before increased 4.614% and after 4.65%. The return on asset before rose 8.14% and after 8.10%. Looking into 2024, Ayala's return on asset before significantly increased to 12.57% and after was 12.57%. The return on equity before also increased to 0.227, roughly 22.77%, and after was 22.77% also. This figure shows a clear upward trend in Ayala's financial efficiency over the 3 years, indicating improved profitability and asset utilization. Now let's analyze San Miguel Corporation. In 2022, San Miguel Corporation's ROA before was negative 0.68% and after was negative 0.46%. Its ROE before was negative 0.01% or negative 1.42% and after was negative 0.95%. In 2023, the ROA before slightly improved to negative 1.20% and after was negative 1.42%. The ROA before also showed improvement to negative 2.55% and after to negative 3.02%. Moving to 2024, the ROA before was negative 1.31% and after was negative 1.18%. The ROE before was negative 3.08% and after was negative 2.77%. Although San Miguel Corporation's figures are negative, indicating less efficient utilization of asset and equity. There is a trend towards less negative values over time, which suggests some improvement in financial efficiency. In conclusion, based on the data, Ayala Corporation exhibits the strongest financial efficiency among the two companies, with significantly positive and increasing return on asset and return on equity over the years. San Miguel Corporation shows some improvement but remains in negative territory, indicating less efficient financial performance during this period.
Now let's talk about how did revenues trend over time, starting from San Miguel Corporation. From 2022 to 2024, San Miguel Corporation's revenue increased dramatically from approximately 18 billion pesos to over 55 billion pesos. That's more than double in just 2 years, indicating robust growth and expanding operations. Turning to Ayala Corporation's revenue saw a significant drop in 2023, from over 45 billion pesos down to about 24 billion, reflecting challenges faced that year. However, in 2024, revenue rebounded slightly to nearly 28 billion pesos, though it has yet to return to 2022 levels. In summary, San Miguel Corporation shows a strong, consistent growth trend, signaling successful business expansion. Meanwhile, Ayala Corporation experienced a decline but appears to be recovering. These revenue trends provide insights to each company's current performance and strategic direction. For investors and stakeholders, understanding these patterns is crucial for making informed decisions.
Now, let's discuss the financial risk of both companies based on their performance from 2022 to 2024. Starting with San Miguel Corporation, the data shows that its revenue increased from 17 billion in 2022 to 34 billion in 2023 and then to 55 billion in 2024. However, despite this growth, the company continued to record losses with net income before tax of negative 7 billion and negative 14 billion and also the 16 billion from the same year. This means the San Miguel costs and expenses were higher than its revenue. Because of this, its profit margin and ROA are all negative, showing poor efficiency and high financial risk. If these losses continue, the company could face problems with liquidity and long-term solvency. On the other hand, Ayala Corporation shows stronger financial stability, even though its revenues declined from 45 billion in 2022 to 24 billion in 2023 and only slightly recovered to 28 billion in 2024. This is show that Ayala effectively managed its costs and resources, keeping its financial risk at moderate level. The only concern is revenue fluctuation, which could affect the stability if not managed well. In summary, San Miguel Corporation faces high financial risk due to consistent losses, while Ayala Corporation remains financially strong with only moderate risk caused by changing revenues.
Hi, my name is Giancarlo C. Delos Reyes. Today we will discuss the finding and recommendation for both company of Ayala Corporation and San Miguel Corporation. These two companies has top conglomerates in the Philippines, showing strong financial performance but in different ways. Ayala Corporation demonstrates steady revenue growth and strong financial efficiency, with high returns on asset and equity due to effective management of its diversified business in real estate, banking, and telecommunication. However, it faced moderate profitability in rising debt levels in some subsidiary. On the other hand, San Miguel Corporation showed higher profitability and strong efficiency ratio, supported by its diverse operation in food, beverage, energy, and infrastructure. Despite this, it faced liquidity challenge due to heavy capital investment and exposure to fluctuating input costs. Overall, it is recommended that Ayala focus on improving profit margins and managing debt, while San Miguel should strengthen liquidity and cost control to sustain growth and stability. Thank you.